Hello there. Welcome to Trading Day. We are seeing selling in stocks amid fears that this rise in energy prices is going to continue for a while. U.S. President Donald Trump saying yesterday that actually restraining or preventing Iran from getting nuclear weapons is a bigger priority than keeping oil prices down. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canada's economy shed the most jobs last month in 4 years. Data from StatsCan indicate that the labour market lost 84,000 jobs in February. Economists were expecting a gain of 10,000 positions. Jobs were mostly lost in the goods and service-producing industries. Meanwhile, unemployment edged higher to 6.7%. The data signal continued softness in the labour market. Shares in Enghouse Systems are taking a hit, falling to their lowest in at least a year. The software company posted lower profit and revenue in its latest quarter, with both missing estimates. Enghouse says it's dealing with ongoing economic shifts, changing predictions regarding AI, and an increasingly unpredictable global environment. However, the dividend is going up by 3%. And there's a look at shares in Rio Tinto. That global mining giant says it will slow down construction of its Nemaska lithium processing plant in Quebec. Bloomberg says the decision is due to surging costs. Construction is expected to fully restart next year. And Rio insists that it will continue to invest significantly in its Quebec lithium business and doesn't see more major changes to the project's overall timeline. And there's the TSX under pressure right now, and despite buoyant oil stocks with this surge we've seen over the past 2 weeks in crude prices. Let's have a look at the U.S. markets. And they have come under pressure. They were staging a bit of a recovery earlier, but there's no sign of an end to this constriction of the Strait of Hormuz, and that is worrying investors. Well, let's see what picture the market is painting for people who follow equities, and in particular, strategy using ETFs. So we're joined by Scott Cronert, U.S. equity and ETF strategist at Citi. Thanks very much, Scott, for joining us. Maybe we could put up a 1 month chart for the equity markets. They tried to rally this morning, as you know, but they're now down. What do you think is causing pessimism right now?
Well, I think it's pretty clear, right? You have the Iran conflict and the oil price response, and I think we've been saying for the past 2 weeks now that duration of conflict is really mission critical in terms of how the market perceives and trades around this, because essentially the longer you go with the conflict as is and with the Strait of Hormuz restrictions, that you have a higher for longer oil price backdrop. And as you go down that path, you begin to conjure up more concern around the economic underpinnings of the economy.
And it looks as though Washington has made moves to try to get more oil on the market, but President Trump insisting that the main thing is stopping the Iranian nuclear program.
Well, I think that's right in terms of an appropriate first mission here. But I still think, again, the fallout in terms of the energy complex is pretty critical. As you know, he's had a number of, fiscal stimulus measures that have been planned to fall into place this year. But essentially what's happening is as you go down this higher for longer oil price path, you begin to look at that as a potential offset. And so, what you have is a situation right now where the labor condition continues to be somewhat of an issue here. But at the same time, if you then look at the inflationary aspects that come with higher for longer oil, then it also puts the Fed in a difficult situation.
The New York Times quotes a retired Air Force general as saying, this is a very difficult problem to solve, keeping traffic going through the Strait of Hormuz. And there are fears that America might, if they really want to do it, might have to occupy that coastal strip of Iran.
Yeah, so, one step at a time, but I think, these options are increasingly being discussed. It's kind of interesting as we step back and look at it, from our U.S. equity lens, but then also in a global context. See, where we fall out on this is that at the margin, the U.S. is probably a bit of a relative outperformer, if you will, given the lesser energy or oil dependency that we have here, along with Canada. And so what ends up happening is as we navigate this situation or issue, our view is that, at least on a tactical basis, the U.S. can be considered that a relative safe haven.
Although, I mean, your economy is still vulnerable to higher oil prices, and they do tend to rise and fall globally.
Yes. Yeah. So that's certainly part of the issue here, but it's relative, right? So we're going to be at the margin, a little bit less dependent than will other areas of the globe. You think Europe, potentially other areas within emerging markets. And so what's so interesting, coming back to your question regarding ETFs, is that when we look at the flow construct that's been going on so far this year, it was fascinating. In February, for the first time in our memory, we had a really, really massive flow into international equity exposures, more so than for domestic equity. And so my point here is that just as many investors had been warming up to the non-U.S. exposures, again, in expectation of ongoing, let's call it soft landing, fairly constructive global economic setups, you've now turned the table pretty quickly. And so just like that, even though, yes, to your point, we do have our own energy sensitivity, from a U.S. equity perspective, think the S&P 500, I still have a big percentage of the index construction, around 40, if not 50%, that's going to be more directly exposed to this AI infrastructure build-out theme, which probably persists in the short term without too much negative overhang from the ongoing conflict.
So we have an S&P around just a bit more than 6,600 right now. And your base case target is still 7,700?
Yeah, we got to give this some time. I'd say the good news on that is that we still have over 9 months to go in the year. But there's no doubt when we were making our full year 26 targets back in mid-December, it was all predicated on, or I should say, a lot of it was predicated on a lot of confidence in the underlying fundamental profile for the S&P. And on that front, the news continues pretty good. On the heels of the Q4 results, our estimates for the S&P 500 earnings at 320, which, again, 3 months ago were literally high on the street, now are starting to look a little bit conservative, given some of the underlying trajectories we're seeing from a bottom-up build-up perspective. So the path to 7,700 clearly starts with fundamentals, but you have to acknowledge or be of the view that the current valuation circumstance can persist. This is where the global conflict element of this comes into play. If it does, I think, create a little bit more difficult backdrop for the Fed to continue to move down an easing path, then you do begin to change the playing field that was or had been part of our target setting 3 months ago.
Have you seen big flows into fixed income ETFs or ETFs that hold income stocks such as utilities?
Yeah, really good point. I think when you go back and look at, in our snapshot, the February ETF flows, I mean, the money moving into fixed income throughout this year has been very, very notable. And we see that on ETFs as well as mutual fund activity. So what I would say here is that as you've had this consternation in the U.S. build around things like AI disruption, around the private credit conversation, and now with the global economic circumstance around the Mideast, fixed income has been a very clear beneficiary from a flow perspective. Again, that begins to face its own trickiness, if you will, because you're seeing 10-year yields back up sort of in response to this nagging concern of will we be looking at a more prolonged inflationary circumstance now.
Thank you very much. I really appreciate it.
Thank you, sir. Talk to you soon.
Thanks a million. That was Scott Kronert, U.S. equity and ETF strategist at Citi. Coming up, Honda shares have taken a hit. That company is warning of billions of dollars of charges tied to its electric vehicle strategy. It's all ahead. We have a couple of electric vehicle stories for you. First off, BYD, China's, I did that earlier as well. China's biggest car maker says it's considering building a manufacturing plant in this country. Let's get more from our own Lindsay Biscaya. Lindsay.
Yeah, and this is what I was saying earlier as well, Andy, is like this is all just a couple of comments that were made from the chief vice president, Stella Lee, in an interview with Bloomberg. And so she was dropping hints of some of the plans that BYD has, and that includes studying the Canadian kind of market and looking for potential manufacturing plants and processing plants here. And she said that BYD would want to own and operate the facility in Canada. So that sounds as though it's ruling out a joint venture. In fact, Stella Lee actually said no to a joint venture. She didn't think that that would work. Of course, this is just initial comments coming from the vice president, but a joint venture would obviously, you'd see a Canadian company and a Chinese company work together. That's something that the Canadian government has kind of wanted. And we'll talk about that more in a moment. But BYD saying no to a joint venture. They do like to do things alone. So again, this is just preliminary. It will be interesting, though, to see how this all works out when you think about Canada's labor codes, unions within this auto manufacturing sector that we have here. It's very, very different from something you would see in China. How that would all work if a company like BYD was actually going to start manufacturing its electric vehicles in Canada, there's a lot of questions still, that's for sure.
Another interesting issue, Honda and Toyota have big plants in Ontario, as you know, but the bulk of those cars go into America.
Yes.
But so would BYD, if it made cars here, would they be eligible to go into the States under CUSMA?
That's another big question, right? I was reaching out to Flavio Volpe earlier today, asking him some of these questions. That's a big red flag because he was saying at this point, if they wanted to actually import their electric vehicles into the U.S., they would have to comply with the CUSMA rules and regulations. And one of those is the local content level. So that means that a vehicle must have 75% North American content. And Flavio Volpe was telling me if they actually did want to meet those requirements, this would be a very gradual process, right, to try to find suppliers and parts within Canada or within North America that would meet those requirements. They don't have to, but they wouldn't really be able to sell their electric vehicles in the U.S. and in Mexico under the free trade agreement that we have right now. So that's a really big question. Also, this is what I was talking about earlier. There is an agreement with China in principle with the Canadian government that requires companies to find a joint venture partner. BYD would have to honor that, or you would think if they didn't, then the government would use the Investment Canada Act to block it. That's coming from Flavio Volpe, like another big question. And what's really interesting, as I mentioned, is the chief vice president was saying no to a joint venture. So that's something you'd have to see whether that agreement would stand. There's still so many questions, but this all comes, of course, as Canada's now allowing in more electric, Chinese-made electric vehicles. And we know that BYD has applied for a permit to start exporting its vehicles to Canada, along with 2 other Chinese companies. And so this is just the start of something. Whether it actually happens is still to be seen, of course.
And Flavio Volpe, the head of the Auto Parts
Yes.
Association.
Yes.
Yeah. I remember he told us a while ago that they tried reaching out to the Chinese car makers about opening a plant here, and that the Chinese companies weren't receptive at that stage.
It's interesting. Yeah. Things can change so quickly in this landscape, but whether they actually go ahead with it, and I know we were speaking with some other analysts this morning, and they were pretty skeptical about whether this would actually all unfold because there's so many hurdles, and whether the prices, these cheap vehicles you see from China, whether they would still be cheap if everything unfolded and happened here in Canada.
Let's get more perspective on shifting tides in the electric vehicle market. We're joined by Sam Fiorani, VP in Global Vehicle Forecasting at Auto Forecast Solutions. Sam, thanks very much indeed for joining us. Could you just start off with that story Lindsay brought us about the possibility of BYD opening a factory in China? There are quite a few hurdles, and obviously would be contentious maybe if they were to be able to ship cars into the US market under CUSMA. What are your thoughts on that?
BYD and the rest of the Chinese market wants to be into North America. Canada is giving them the opportunity to join the group, and opening a plant locally would allow them to make the step to move into the US market eventually. As was pointed out, making sure you get to 75% local content is one step that's going to be necessary. Another step is getting around the US limit on Chinese software and hardware, which is gaining over the next few years, and will limit the number of Chinese vehicles that can be sold in the U.S. This is a gradual growth of that, and another limitation of bringing vehicles into the U.S.
That's interesting. Yeah, I don't know if the Canadian government has even raised concerns over the fact that these vehicles are just computers on wheels, and there are fears that the Chinese could manipulate the technology. Could we move on to Honda? Honda is looking at financial charges over its EVs, like so many other companies.
Yes, everybody has moved so far forward into electric vehicles, and they were ahead of the curve. The demand in the United States, in Canada, in a lot of countries is not moving as fast as the supply has. In the U.S., for example, there are far too many vehicles on the market for the number of buyers for them, and the $7,500 U.S. Incentives that consumers had was helping the manufacturers bring those vehicles to the market. But without them, which they were removed last fall, these vehicles are so much more expensive for manufacturers to sell, and consumers aren't looking for them at the moment. Honda had brand new electric vehicles coming in, and they've canceled them at the very last minute. The Acura was supposed to go into production in July. We're going to see Honda moving towards electrification beyond the hybrids they already have, but it's going to take more years. It's going to be sometime in the next decade before we see a Honda electric vehicle in North America.
And Honda now say they anticipate their first annual loss since they listed the stock publicly in the late 50s, and they're looking at charges of more than $15 billion US.
Yes, these costs are extreme. We had to develop new platforms. We had to build plants or convert plants to build the electric vehicles. It's a lot of cost for all these manufacturers, and the write-down is just to get them over this current hump and get them back to building ICE vehicles as the market wants.
The New York Times notes that Rivian and Lucid, they're both US-based car makers. Right now, their vehicles start at more than 70,000 US, but they are talking about cars that would be priced under 50K. So these startups seem to be going ahead while the established car makers pull back.
The electric vehicle startups don't have a choice. They don't have an ICE vehicle or a hybrid vehicle to rest on, so they have to make their EVs work. Rivian and Lucid are taking the Tesla model. They come to the market with an expensive model. It sold well. It made some revenue for the company, and they're going to move down to lower cost vehicles that have higher volume and potentially a wider market reach. So the idea is that the R2 for Rivian and the new models for Lucid will open up the market to hundreds of thousands of buyers as opposed to the tens of thousands of buyers they currently have on their current models.
Are they viable in the long term, Lucid and Rivian, do you think?
Lucid has money from the Saudi public fund. And Saudi Arabia needs to, they're looking ahead. They're trying to find a way beyond the petroleum economy. So they need to branch out into other things. So they've got a Lucid plant in Saudi Arabia. There's a Lucid plant in the United States. They're looking forward to investing in this company and keeping it going long term. Rivian, on the other hand, has Volkswagen money. It has public offering money. They need to get over this current stage and get into their mass market products before they can start making money and making a profit.
Yeah, I see Rivian stock in 2021. It briefly got north of $170 US, but it's kind of drifted since then. Right now, it's about $15. Thank you very much, Sam. Lots going on in the EV space. Really appreciate it.
Thank you.
Sam Fiorani, VP in Global Vehicle Forecasting at Auto Forecast Solutions. Coming up, unemployment ticking up to 6.7% in Canada for the month of February. We'll have more after this. Canada shed lost jobs last month. The economists had expected a small gain. In fact, the loss was the biggest in more than 4 years. We talked to Travis O'Rourke, president of the recruitment firm Hayes.
I think economists' general sentiment was we were going to add 10. I thought we'd add actually more than 10,000. So to see us shed 85, I mean, it's a moment in time. But there's very, very little good news you can pull from this one, Andrew.
Is it possible to speculate on what caused this one terrible month?
You know, like you've got the services sector's down, manufacturing's down, wholesale's down, construction's down. To actually find positive, this is a general softening across the whole country. Now, like I say, it is a moment in time. From someone who lives and breathes and buys groceries on employment data, I'm not going to sweat this one. This is bad. But anecdotally at Hayes, this is not what we're seeing. And I think the spring and summer, we're going to get better data.
That's interesting. So it won't continue at this dismal rate, you don't think?
Listen, what we're seeing on the ground and what economists are predicting was not this number. I think there's so many good things happening in the Canadian economy. A lot of the infrastructure investments that Carney's made. Yesterday was a great one. Kuzma clarity coming July 1st. That's what everyone's really waiting for. But I think there's brighter signs ahead.
You say that we're in the employment market. Normally, it's shaped like a pyramid. There's a few jobs at the top. There's lots of entry-level jobs. But it's more like a diamond now. The entry-level jobs are few and far between.
That's right. I'd say, like you see the youth employment data, we're not as bad as we were in September. But yeah, we're in what I would call like a low hire, low fire market. So you're not seeing those big layoffs going anywhere. But that diamond shape, where to get in that entry-level role right now, is very difficult. So people are still moving up nicely. But whether it's companies, it's easy to cut costs by saying we're not hiring new grads. It's easy to cut costs by getting some of those repeatable low-level jobs replaced by AI. And so the trouble we're going to see is 2, 3, 4 years from now, when those entry-level employees don't exist, who's going to do the middle-level roles? But yeah, the pyramid is becoming a diamond.
I guess some of the middle management jobs will start going with AI as well.
Certainly the white-collar ones, yeah. I think it becomes a lot easier to make decisions. Data is a little bit more readily available. You need fewer people to make those calls. AI is changing everything.
Yeah, there was that Citrini research a couple of weeks ago now saying that a lot of people make their living by dealing with tedious stuff like tax filings or bureaucracy. But if AI allows the customer to do that, those jobs may go.
Yeah, if AI allows the customer, or if AI makes decisions faster. I mean, we look at some of the holdups that we've got in construction right now, or the amount of time it takes to do permitting. You should be able to send a permit into a system, 10 seconds later, AI approves your build. Instead, you're waiting 6, 8 months going through red tape for someone to actually get to your file. So there's a lot of ways that AI is actually going to increase employment, to make things move a lot faster. But right now, the bureaucracy is certainly in my sight line.
The bureaucrats will resist that, though. They'll come up with ideas why they're essential.
Yes, of course. But yeah, construction for me, Andrew, that's like a huge potential for us. Your previous guest is talking about the Mackenzie Highway up to the north. to spend $35 billion on defense, it's only good if you can get there. And I think Carney's made some great announcements on the Ring of Fire for the mining. There's a global demand for rare earths and critical minerals needed for data centers, but you have to get there. So the railways, the roads, all the infrastructure required to make that happen, our construction sector is ready to go.
But there's still this perennial shortage of skilled workers.
Perennial shortage of skilled workers, yeah. I think skilled trades specifically is going to be a major challenge. We've got about 700,000 skilled trades workers set to retire by 2028, and we're only graduating 75,000 per year. To me, the answer is women. Women are so underrepresented within skilled trades, and I think they're about 8% of total trades. When you get into fields like welding, it goes down to about 4%. So we cannot address the gap in skilled trades without engaging females into that workforce.
Yeah, that's a big waste, all right. Yeah. I guess workplace culture will have to change in some cases, just so women feel more comfortable.
Yeah, I think workplace culture has to change. I mean, honestly, some of it is just structural within the buildings or on the sites. Like even things as simple as bathrooms.
Yeah.
But when you look at how to get a job on a construction site, a lot of it comes down to referrals. And Jimmy knows Tommy.
Right.
Well, Jimmy also knows Jenny. And I think it's a requirement for employees at any construction site in any trade to start promoting women, to start talking about them, to get into schools. Jack of all trades needs to be Jill of all trades. And the answer is right here. And with International Women's Day that happened this week, I want to see more people in the private and the public sector starting to elevate these women into the jobs that the economy needs.
Travis O'Rourke, president of Hayes. Coming up, rising energy markets squeezing the market. Is it a time to pick individual stocks? We'll have more after this. Canadian economy losing the most jobs in more than 4 years last month, driving the unemployment rate up to 6.7%. StatsCan says employment fell by almost 84,000, with losses concentrated in full-time and private sector work. China says it will impose anti-dumping tariffs on certain rubber products from Canada and Japan, with the new levies taking effect tomorrow and remaining in place for 5 years. Now, tariff rates will be just over 30% for most Japanese companies and about 14% for Canadian producers. The administration of U.S. President Donald Trump has begun a second trade probe in a bid to replace those emergency power tariffs that were rejected by the U.S. Supreme Court. Trade Representative Jameson Greer says the targets of this investigation include Canada, Mexico, the EU, China, and Britain, among others. Now let's have another look at the markets. We're closing out the week on a down note. You can see the TSX slipping in midday trading. Let's have a look at the U.S. markets. They did start off higher, but now dropping on fears that this oil cutoff, which could be 10 million barrels a day, because sure, 20 million normally goes through the Strait of Hormuz. There are other routes for getting it out, but it could be 10 million barrels a day. That's 10% of world daily consumption, and it's likely to go on pushing up prices unless they can resolve the situation. We talk a lot about the indices, the broad benchmarks for the market. The S&P, of course, it is down, but it looks relatively steady on the surface. There hasn't been a panic among investors, even though it has slipped a little bit this year. Our guest says, though, under the surface, there's rising dispersion between stock sectors, and that paves the way for buying opportunities. Let's get more from Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to see you. What shifts are you seeing beneath the surface of the market?
Hey, Andrew. Thanks for having me on again. And I think I can speak for all investors today, TGIF, given all that's going on in the world right now. When we look at the market, at the index level right now, it looks like bulls are losing some control. We're starting to break down early signs of this consolidation range below 67.75 on the S&P 500. And then when you dig into the details of that and look at the constituents, we're seeing weakening breadth, so less participation. In our trend model, we actually have less than half of the index now in some form of an uptrend. That's been deteriorating over the last few weeks. Contributing to that is weakness in financials, another area that's a bit of a concern when you think about a bull market. You want to have financials participating. They're a proxy for the economy as well when you think about the banking sector. And the weakness there, I think it all boils down to maybe some further volatility and some maybe further downside here for the S&P 500.
That's interesting. Yeah, because we do talk about the market, but we forget it's a market of stocks, hundreds of stocks. And just remind us, sorry, how many stocks appear to be in a downturn right now?
So right now, when you look at the percentage of S&P stocks in downtrends, we're at about 52% within our work. Leading that, you have consumer discretionary, about 2/3 of that sector in some form of a downtrend, and then financials not far behind, about 1/3 of financial stocks in some form of a downtrend. That's not the leadership you want to see. It's been a defensive rotation as oil spiking higher, and that's really in the driver's seat in driving sentiment and driving flows right now. Clearly some risk aversion taking place as there's a lot of uncertainty going on in the Middle East.
What broad strategy do you recommend right now? Would you look at high risk stocks in any area, volatile stocks, let's say, in commodities?
Well, commodities look really interesting right now, and it's not just oil. If you look at gold and silver, they've had impressive runs over the last few years. We don't see those trends changing. We've been positive on precious metals now for a couple of years. The fundamental drivers are still in place. They've been a little bit in question on a near-term basis with the dollar moving higher, with interest rates moving higher. That's what we think is a pullback opportunity in precious metals. And then look at the ag space with wheat breaking out, soybeans breaking out. Of course, some of that is due to the geopolitical conflicts going on in the world right now, but a pretty constructive backdrop overall for the commodity space outside of just the energy trade right now.
Fears of big losses in the private equity market are weighing on banks. Are you seeing bargains emerging in the big lenders in the U.S. market?
Right now, banks look a little bit questionable. If you look at some of the big names in that space, a name like JP Morgan breaking down from an uptrend, breaking below some key support levels. And the valuation support isn't quite there when you look at where it's trading price relative to its book value, not at trough type levels. So we do think there could be some further downside until you get valuation support in this space. But we do think it's going to be a volatile year. That was our base case coming into 2026 and really policy driven. We don't think that's changing. And we do think it is more of a stock pickers market. You have very high dispersion among the S&P 500. So lots of outsized returns in both directions and very low correlation. And that produces a pretty good backdrop for the stock picker out there right now.
Although history shows that you're often better off just with an index fund. So many managers traditionally have such trouble keeping up.
Right. It's been tough for the traditional asset manager to outperform, but it depends on the market environment. And we think this current market environment, we're likely more of a consolidation phase. We still think the bull market is alive and well, just subject to a little bit of a drawdown here, maybe down to the 200-day moving average. And that's maybe more of the buying opportunity investors should be looking for. If we get down to those levels and hold right around 6,600 on the S&P 500, that would be, I think, a dip worth considering to buy.
That's interesting. So we are at around 6,600 right now on the S&P 500. So would you be more concerned then if the market dipped decisively below that?
Right. If we break below the 200-day moving average and then the November lows right around 65.20, I think the conversation of the durability of this bull market is going to be in question. And that was where we're a little bit more concerned about the market really rolling over. When you look at the fundamentals, though, we look at the market through different lenses, of course, technical as well as fundamental. The fundamental story remains unchanged. Even though we have obvious risk with inflation right now surging, we think if tensions in the Middle East can cool down a little bit and oil starts flowing through the Strait of Hormuz, we'll go back to worrying about the AI disruption trade and all the other things that were on on the calendar and on the table earlier this year.
What about the Mag 7 stocks that have suffered this year? Are you seeing bargains there?
Glad you brought that up, because the Mag 7 and the mega caps have actually been holding up pretty well. Maybe it's a safe haven trade. These companies have high free cash flow, quality type earnings. And when you look at the Mag 7 index right now, it's hovering right around its 200-day moving average. It has held that level on several retests. So the fact that we'll call it big tech is not rolling over is, I think, a good sign maybe that we're getting close to a peak type of drawdown in the market with some wiggle room, of course.
Thank you very much, Adam. Always great talking to you.
All right, thanks for having me.
Adam Turnquist, Chief Technical Strategist at LPL Financial. We just told you about the dismal job numbers for February. The restaurant sector is a major employer. We're going to talk to a guest who will address the question, is Canada set to lose 4,000 restaurants this year? That's ahead. The restaurant industry is in trouble, according to our next guest, with many struggling to stay afloat. In fact, he says that Canada is set to lose 4,000 restaurants this year. We're joined by Sylvain Charlebois, Agri-Food Analytics Lab Director and Professor at Dalhousie University. Sylvain, thanks very much indeed for joining us. 4,000 restaurants, that's quite a chunk. What is the main problem?
Actually, we're expecting more than 4,000 restaurants to close. We're looking at a net loss of 4,000. So obviously, some restaurants will open this year.
I see. Yeah.
Yeah. So we're looking at a count of 85,000 restaurants, down from 89,000 at the start of the year. Last year, we actually had a net loss of 7,000, so it won't be as bad. Now, keep in mind that in 2022, 2023, and 2024, there were gains. We actually did see an increase in the number of restaurants. So I do see this, Andrew, as a normal correction based on fundamental economics. People have less money to spend. And the other big issue is alcohol. How can you possibly make money as an operator when you can't upsell on appetizers, desserts, and of course, alcohol? And we all know that with alcohol, margins are much, much higher than with food.
So we have quite a lot of restaurants in Canada. I mean, the StatsCan figures for 2024 show about 67,000 that are employers, and then another 20,000 that are not employers. I guess they're just one-person shops or something. But that is one thing that I find kind of sad here is that you reckon that the independents are most vulnerable, because I always find it depressing when chains supplant independent restaurants.
Absolutely, and often headlines are focused on chains, but the travesty of it all is to see, as you just mentioned, independents leave the market, and independents tend to innovate more, really. Most restaurants do innovate. I mean, chains do innovate, but the real innovation, the really disruptive innovation really comes from independents typically, and we saw that with sushi many decades ago. And typically independents come into our country with different cuisines, different flavors that Canadians actually do enjoy.
Yeah.
And so that's honestly, that is going to be the one category that is likely going to be hit this year by the number of restaurants dropping.
Yeah, I'd love to see a city like Toronto limit chain restaurants. Do we need another identical fast food outlet? In any case, you know, I mean, it's just boring. It's Stalinist. But in any case, let's move on. Speaking of chains, a lot of them now have those boards that you go in and you have to place your order and pay in advance.
ATMs.
Yeah. So we are seeing automation cutting employment.
Absolutely. So this week in Toronto, I was actually speaking at the Restaurants Canada show. It's a huge show, 1,400 exhibitors in Toronto. And obviously automation, robotics were big themes. Labor is an issue. We know that the federal government is looking into cracking down on foreign workers in restaurants all over the country. So restaurant operators are finding ways to automate as much as possible. especially in the QSR space, not so much with fine cuisines or casual even, but really with QSR, clearly there's some momentum around automation and robotics right now.
It's just expensive. You touched on this. It's just expensive to go out, particularly in a city like Toronto. It's hard to get a dinner for, well, depending on where you go, but for $80 or $100, even without booze sometimes.
Absolutely. And I know, I don't know about you, Andrew, but a lot of people I know haven't been to a restaurant in months, sometimes years, because they just can't afford it. It is expensive. And this is the reason why alcohol is such a big issue, because typically operators would make money selling alcohol, but you can't sell alcohol. You have to increase your menu prices. Mm-hmm. And a lot of people have been sticker shocked by some of these menu prices, so they just stay home. They do order in. They do use apps like Uber Eats or Skip, avoiding the expensive tip, because you do tip more at the restaurant than tipping your delivery person. Mm-hmm. And also you're avoiding the expensive bottle of wine as well. So people are much more frugal.
Yeah, and people are drinking less. I was looking at a story about Ireland relating to Paddy's Day next week, and there are now dry pub crawls in Dublin. People go out and they drink near beer.
Are you serious?
Yeah, that's right. Yeah. Some people, of course.
Oh, my goodness.
Yeah, well, Guinness has done well. They have a zero alcohol Guinness out there. Yeah, the Irish are drinking less.
Well, I guess to each his own, I guess.
Yeah.
But I know as long as people have fun responsibly, that's the most important thing, I guess.
Yeah. I guess we're all getting older. Our metabolism isn't as good, and you just don't want to feel wrecked the next day.
I'm getting older, too, so I'm always careful. Absolutely.
Yeah. But Sylvain, it is a pity. And the government, of course, spent a lot during COVID, didn't it, to try to keep the sector afloat?
Well, that's kind of what's happening right now. So there's some right sizing going on. And frankly, at the RC show this week in Toronto, I mean, the place was packed. A lot of people felt optimistic about the market because they know that over the last few years, it's been very difficult to measure the performance of the sector. So there is some right sizing going on right now for sure. But I do expect the sector to bounce back in 2027 for sure.
Okay, the Restaurants Canada show. Thank you very much, Sylvain. Always appreciate it.
Take care. Bye-bye.
Coming up, we're going to check in on the markets. Before we go, investors have been buying into some Canadian utility stocks. We'll be right back. Let's have a quick look at the markets before we go. The Americans insisting that they have stepped up strikes on Iran to new heights. And the Defense Secretary, Pete Hegseth, says that U.S. and Israel have hit about 15,000 targets since the war began, and that Iran's new leader has been wounded, or he's reported to have been wounded. Let's have a look at the U.S. stocks now. And, of course, the question is, how high will oil go? And there's frantic efforts to get more on the market, but we've seen oil trading, last time I checked, above $97. So no real joy there. Investors are apparently taking or seeking safety in some utility stocks. We saw in Toronto, we saw Fortis, Emera, and Hydro One, all vendors of electricity, hitting record highs today. Of course, they would be classic defensive plays, and investors like the look of electricity stocks as we spend more of our time with our AI companions, needing all that data crunching. Let's have a look at Go Easy. This is the high-risk lender that warned investors of almost $180 million in write-downs. Shares, and the stock collapsed, lost half its value. Shares are bouncing a bit. I see S&P, though, now downgrading the credit rating to B-, and it's still on credit watch negative. There's the stock down 60% this week. The previous rating was double B-. B- is way down there. That's Mordor as far as credit quality is concerned. The company is expected to have to get into negotiations with its creditors, but looks like investors see some value there. Risk takers, sporting types buying the stock right now. Thank you very much indeed for watching Trading Day. Have a wonderful weekend.